You know, most people think investing is about being smart, about having insider knowledge, about predicting the future. But Benjamin Graham saw something very different. He believed investing was mostly about behavior, about how you think when others panic, about how you act when prices scream fear. Graham lived through crashes, depressions, wars, and market manias. And what he learned wasn't complicated, but it was brutally hard to follow. He understood that the stock market doesn't exist to help you make money. It exists to test your patience, your discipline, and your emotions every single day. And most people fail that test not because they lack intelligence, but because they lack emotional control. Graham often described the market as something irrational, almost moody. One day it's euphoric, convinced everything will go up forever. The next day it's terrified, convinced everything is falling apart. Prices swing wildly not because businesses change overnight, but because human emotions do. Fear and greed push prices far above and far below true value. And this is where Graham's most important idea begins, the idea that made him different from almost everyone else. He said price is not the same thing as value. The market tells you what you can pay today. Value tells you what something is actually worth over time. And confusing those two is how fortunes are destroyed. Imagine walking past the same house every day. One day someone offers to sell it to you for double its worth because they're excited. The next day they offer it at half price because they're scared. The house hasn't changed. Only their mood has. Graham believed the stock market behaves the same way. And instead of reacting emotionally, the intelligent investor learns to take advantage of these mood swings, not by predicting them, but by staying calm when they happen. This is where most people get it wrong. When markets rise, they feel safe. They buy because everyone else is buying. When markets fall, they feel danger. They sell because everyone else is selling. Graham warned that this behavior guarantees poor results. He believed that the crowd is almost always wrong at the extremes. Maximum optimism happens near market tops. Maximum fear happens near market bottoms. And if you simply follow the crowd, you end up buying high and selling low, the exact opposite of what investing is supposed to be. Graham didn't believe investing should be exciting. In fact, he believed excitement was a warning sign. The more thrilling something feels, the more dangerous it usually is. Real investing, in his view, was slow, methodical, even boring. It required analysis, patience, and a willingness to look wrong in the short term in order to be right in the long term. He taught that the goal of investing is not to beat others, but to avoid serious mistakes, because avoiding big losses does more for your long-term wealth than chasing big wins. One of Graham's most powerful concepts was something he called the margin of safety. It's simple but profound. It means never paying full price for anything uncertain. It means building a buffer between what you pay and what something is truly worth. Because the future is unpredictable. Earnings can fall, economies can slow, mistakes can happen, and the margin of safety protects you when they do. Without it, even a small error can turn into a permanent loss. Most investors ignore this idea because it feels conservative, because it feels slow, because it doesn't promise instant rewards. But Graham understood something most people never do. You don't need brilliance to succeed in investing. You need survival. You need to stay in the game long enough for compounding to work. And compounding only works if you avoid catastrophic losses along the way. Graham also believed that investors should separate themselves from market noise. He warned against reacting to headlines, forecasts, and daily price movements. The market, in his view, is there to serve you, not instruct you. It offers prices. You decide whether those prices make sense. And most of the time, the best decision is to do nothing at all. Waiting, Graham believed, is an underrated skill. Sometimes the smartest move is patience. He understood that emotional discipline is harder than financial analysis. Numbers can be learned. Temperament must be trained. The market will tempt you to act when you shouldn't, and discourage you when you should act the most. Graham believed successful investors develop the ability to detach emotionally from price movements, to see them as opportunities rather than threats, to remain calm while others lose control. And here's the twist most people never expect. Graham didn't believe the average person needed to be extraordinary to succeed. He believed the average person could do extremely well simply by being disciplined, conservative and consistent, by refusing to speculate, by refusing to chase trends, by refusing to follow crowds. Wealth, in Graham's world, wasn't built loudly. It was built quietly, patiently, and almost invisibly over time. He warned that the greatest enemy of the investor is often not the market, but themselves. Their fear during declines, their greed during rallies, their impatience during quiet periods, and unless those behaviors are controlled, no strategy will ever work consistently. This is why Graham focused so much on mindset, because technique without discipline is useless. By the time Graham's ideas became widely known, markets had already changed in appearance, but not in nature. Technology evolved. Trading speeds increased, information became instant, but human psychology stayed exactly the same. Fear still feels the same, greed still feels the same, and markets still overreact in both directions. That's why Graham's principles remain timeless. They don't depend on trends, they depend on human nature, and this is where everything starts to come together. Graham wasn't trying to beat the market every year. He was trying to survive every year, to protect capital first, to grow it steadily second, and to let time do the heavy lifting. Because time rewards patience, not prediction. It rewards discipline, not drama. Most people want certainty. Graham accepted uncertainty and built systems around it. Most people want excitement. Graham wanted safety. Most people want fast results. Graham wanted lasting results. And that difference in mindset is why his ideas outlived entire market cycles, trends and financial fashions. What he understood better than almost anyone is that investing success is less about what you do and more about what you avoid. Avoid panic, avoid speculation, avoid overconfidence, avoid leverage, avoid following the crowd. Do that consistently, and the results take care of themselves. And here's the emotional truth most people don't like to hear. The market doesn't reward effort. It rewards discipline. It doesn't care how hard you try. It cares how well you behave when things don't go your way. And that lesson, more than any formula or metric, is what separates lasting wealth from temporary luck. This isn't a story about getting rich quickly. It's a story about not getting poor slowly, about protecting your future from your own worst instincts, about learning to think independently when everyone else is thinking emotionally. And that mindset, that quiet strength, is the real legacy Benjamin Graham left behind. What made Benjamin Graham truly different was not just how he invested, but how he thought about risk. Most people believe risk comes from volatility, from prices moving up and down. Graham rejected that idea completely. To him, volatility was not risk. Volatility was information. Real risk, he said, came from overpaying, from not understanding what you own, and from being forced to sell at the wrong time. That idea alone changes everything. Because if price movement is not risk, then fear-driven selling becomes the real danger. Graham understood that markets will always fluctuate. That's not a flaw, it's a feature. The problem arises when investors mistake those fluctuations for signals. A falling price doesn't mean a business is worse. A rising price doesn't mean a business is better. It only means sentiment has changed, and sentiment is temporary. Value is not. Graham trained himself to see price drops as invitations, not warnings, but only when value was present. He never bought something simply because it was cheaper than yesterday. He bought because it was cheaper than it was worth. This is where discipline becomes uncomfortable, because value investing often means standing alone. When others are celebrating, you look cautious. When others are panicking, you look calm. and humans hate standing alone. Graham knew this. He knew the hardest part of investing is psychological isolation. You will feel wrong before you are proven right. You will feel foolish before results show up. And if you can't tolerate that discomfort, you will abandon the strategy at the worst possible moment. He warned that most investors don't fail because they lack opportunity. They fail because they lack patience. They enter markets with unrealistic expectations. They want fast returns. They want constant validation. But the market doesn't work on your emotional timeline. It works on its own. And those who demand immediate results often make decisions that destroy long-term outcomes. Graham also emphasized the importance of distinguishing between investment and speculation. This distinction is critical. An investment, in his view, is something that offers safety of principle and an adequate return based on analysis. Anything else is speculation. That doesn't mean speculation is evil. It means you must be honest about what you're doing. The danger comes when people speculate while believing they are investing. That's how losses become permanent. He saw speculation disguised as confidence all the time. People buying because prices were rising. People trusting narratives instead of numbers. People believing stories instead of balance sheets. Graham had no interest in stories. He wanted evidence. He wanted proof. He wanted assets, earnings, and a clear margin of safety. If those weren't present, he walked away. No matter how exciting the opportunity looked, one of his lesser-known insights was that simplicity is a competitive advantage. Complex strategies often exist to impress, not to protect. Graham believed that if an investment couldn't be explained simply, it probably wasn't understood well enough. He preferred clear logic over clever complexity, because complexity hides risk. Simplicity exposes it. This philosophy shaped how he taught his students. He didn't teach them how to predict markets. He taught them how to think, how to remain rational when others are emotional, how to slow down when others rush, how to say no far more often than yes. Because great investments are rare, and forcing action usually leads to mistakes. Graham also believed that time is neutral. It doesn't help bad investments and it doesn't hurt good ones. Time only reveals what was already there. If you buy something flawed, time exposes it. If you buy something strong, time rewards it. This is why he emphasized quality alongside value. Cheap alone was never enough. Cheap without strength is a trap. Cheap with strength is an opportunity. He warned investors about overconfidence during bull markets. Success creates dangerous habits. When things go well, people assume it was skill rather than conditions. They increase risk. They loosen standards. They abandon margins of safety. And that's when future losses are planted. Graham believed humility was essential in investing. The market can be generous, but it can also be unforgiving. Another core belief was that financial independence is not about maximizing returns, but minimizing regret. Losing money hurts more than making money feels good. And large losses don't just damage portfolios, they damage confidence. Graham wanted investors to stay emotionally intact, because once confidence is broken, rational decision-making collapses. He believed investors should prepare for bad outcomes even during good times, not because they expect disaster, but because protection is cheaper before it's needed. He encouraged conservative assumptions, strong balance sheets, and diversified exposure, not to eliminate risk, but to survive it. Survival was always the first goal. Growth came second. There's a quiet irony in Graham's philosophy. By focusing on defense, he created offense. By prioritizing safety, he unlocked opportunity. While others were chasing performance, he was building resilience. And resilience over time produces extraordinary results. Graham also understood that wealth is built more by what you don't do than by what you do. Don't overtrade. Don't follow trends blindly. Don't ignore fundamentals. Don't let emotion override logic. Don't confuse popularity with quality. These rules don't sound exciting, but they quietly eliminate most paths to failure. He believed markets would always tempt investors to abandon discipline, new eras, new technologies, new promises. But beneath every new story, the same old psychology exists. Fear of missing out, desire for validation, pressure to act. Graham's approach was an antidote to all of that. Slow down, measure twice, act rarely. Perhaps the most human part of Graham's thinking was his acceptance of imperfection. He didn't expect to be right all the time. He expected to be right enough. He didn't aim for flawless timing. He aimed for favorable odds. He knew mistakes were inevitable. That's why margins of safety mattered so much. They allowed room for error, and this is where the emotional core of his philosophy reveals itself. Graham wasn't trying to outsmart the market. He was trying to protect people from their own impulses, from fear that causes selling at bottoms, from greed that causes buying at tops, from impatience that causes abandoning sound strategies too early. He understood that investing success doesn't come from intelligence alone. It comes from temperament, from the ability to remain steady when the world feels unstable, from trusting analysis over emotion, from letting logic speak louder than noise. This is why his ideas continue to matter. Not because markets are the same, but because people are. And as long as humans feel fear and greed, Graham's principles will remain relevant. Because at its core, investing isn't about money. It's about behavior under uncertainty. And those who master that behavior quietly, consistently, and patiently end up with something far more valuable than short-term gains. They end up with control. Benjamin Graham also believed that freedom, real freedom, comes from understanding your relationship with money. Most people think money gives freedom because of what it buys. Graham saw it differently. He believed money gives freedom because of what it removes. It removes fear. It removes desperation. It removes the pressure to make bad decisions at the wrong time. And that freedom is priceless. Because when you're not desperate, you don't chase. When you're not afraid, you don't panic. And when you're not rushed, you can think clearly. He warned that the market constantly tries to hurry you. It wants you to act now, buy now, sell now, react now. But urgency is rarely your friend in investing. Urgency benefits sellers, promoters, and speculators. Patience benefits owners. Graham trained himself to move slowly in a fast world, to wait when others rushed, to observe when others reacted, and that patience compounded quietly over decades. Another idea Graham emphasized was independence of thought. Not stubbornness, not arrogance, but independence. The ability to think for yourself even when surrounded by confident opinions, especially when surrounded by confident opinions. He believed that if you need agreement to feel comfortable, the market will exploit that weakness. Because the market often rewards uncomfortable decisions and punishes comfortable ones. He taught that popular ideas are rarely profitable by the time they become popular. When everyone agrees, the price already reflects that agreement. The opportunity existed earlier, when doubt was high and confidence was low. And that's why emotional discomfort is often a signal, not a warning. It tells you you're thinking independently. Graham also understood something deeply human. Regret shapes behavior more than logic. Investors fear regret more than loss. They fear being wrong publicly. They fear missing out more than losing quietly. And this fear pushes them into crowded trades and out of lonely opportunities. Graham's discipline was his shield against regret. He accepted that being wrong temporarily was part of being right eventually. He never tried to look smart. He tried to be safe. He never tried to impress. He tried to endure. And endurance is underrated in a world obsessed with speed. Markets don't reward brilliance once. They reward consistency over time. They reward those who stay, standing while others burn themselves, out chasing shortcuts. There's a moment every investor faces that reveals who they really are. It's not during booms. It's during silence, when nothing is happening, when prices drift, when excitement fades. That's when impatience whispers. That's when doubt creeps in. That's when people abandon sound strategies, searching for stimulation. Graham understood that boredom is a test, and passing that test separates long-term investors from short-term gamblers. He believed wealth should grow quietly without drama. Loud money is usually temporary. Quiet money lasts. The people who build lasting wealth often don't look like they're doing anything special. They're not constantly trading. They're not reacting to every headline. They're simply letting time, discipline, and sound judgment do the work. One of the most powerful truths Graham left behind is that the market doesn't owe you returns. It doesn't reward effort, intelligence, or intention. It rewards preparation. It rewards discipline. And it rewards those who respect risk, even when others ignore it. Losses are not unfair. They're often the price of ignoring reality. Graham accepted that uncertainty is permanent. He didn't fight it. He designed his approach around it. He assumed things could go wrong. He assumed forecasts could fail. He assumed emotions could interfere. And by assuming weakness, he created strength. That mindset alone protected him from most catastrophic mistakes. In the end, Graham wasn't teaching people how to beat the market. He was teaching them how to survive themselves, how to resist impulses, how to slow down, how to protect capital. Because once capital is protected, growth becomes inevitable over time. His legacy isn't a formula. It's a mindset, a way of thinking that prioritizes reason over reaction, substance over story, value over hype, and patience over panic. And here's the final truth that makes his philosophy timeless. You don't need perfect timing. You don't need secret knowledge. You don't need constant action. You need clarity. You need discipline. And you need the courage to do very little when doing nothing is the right decision. Markets will rise. Markets will fall. Fear will return. Greed will return. Nothing about that will ever change. But if you understand what Benjamin Graham understood, that value outlives emotion, that patience outlasts panic, and that discipline defeats chaos, then you don't have to fear the market, because you're no longer reacting to it. You're using it. And that quiet advantage, sustained over a lifetime, is how real wealth is built.